Hello and welcome to Looking at the Markets with David Modell. I have one of my favorite guests. He is a return guest. He is Mr. Lior Gantz from wealthresearchgroup.com. I recommend that you go to that link in the description and also on the screen right now, wealthresearchgroup.com/watch list. We're going to talk about that and the amazing gains that can be made even when markets seem overpriced. Mr. Gantz, welcome back to Looking at the Markets, sir.
Hi, David. Thank you very much.
Yeah, I mean, your picks have been really impressive. I know you send out watch lists to all your followers on wealthresearchgroup.com. You also have a newsletter. People need to check that out. It seems like the market just feels overpriced in terms of multiples, valuations. They look stretched to me. How can we find anything resembling a bargain in these markets?
First of all, I don't think the markets are stretched right now. They're stretched compared to history, but not stretched compared to what's out there. So if you're an investor and you have money to put either in stocks, bonds, real estate, or otherwise, there's a big case for stocks. It may be that in certain stocks, and there is a bubble in certain stocks, they're just dream stories. They're not really companies. You're paying for 100 years of growth. So I'm definitely on the same page as you are in terms of the fact that there are very unattractive situations out there. But overall, in general, there's a big case for many stocks, many companies that are great opportunities right now. Because if you look at what is out there in general, there is a problem where the world's biggest market, the bonds market, is not a player anymore when you look for yield. Now, lower and lower yields have created a bull market in the price of bonds. So if you were able to conceptualize that in the past 38 years, bond yields will keep dropping and dropping and dropping and dropping and dropping. Well, you made a fortune at the face value of bonds. But if you're like most pension funds and sovereign wealth funds, etc., and you're looking for, or insurance companies or retirement funds, you're looking for the fixed income angle of bonds, then that is mostly gone. And you can look at the dividend yield of even the S&P 500 and the Dow Jones and tell yourself, well, the dividend yield here is higher than what I get on a 10-year bond. And that's why stocks, while they're very overvalued compared to other periods in the 20th and 21st century, relative to what's going on out there today, and you can always look, and you can only look at what's going on today. It doesn't matter what happened 10 years ago or 20 years ago. It has no merit on your decisions today. Stocks are still a very attractive asset class. You just have to know what you're doing. I think that's really important. If you go to that link to this, wealthresearchgroup.com/watch list, man, that has 7 or 8 watch lists right now. The first one was published in April 2020, and the latest one just a few days ago on the 4th of February. There are companies in there that are either from the September, the October, or the December watch list, and even the January watch list that are up between 40 and 400% in 2 months. So there's definitely a case for the right type of companies, and there are definitely companies that are not fully valued or overvalued. I think in this type of environment, it's not the indices that are most attractive. It's individual companies that you can find out there. So that's one thing, David. But for sure, there's been a dramatic shift in the market since March. We believe that April 2020 was the bottom for the 11-year bear market in commodities. Do you remember when oil went negative on the options expiry date? It went negative 35%, $35 a barrel.
Yeah.
Even for a few minutes negative $42 a barrel of oil.
Yeah.
That to us was the day of the bottom for the commodities super bear market, and we've just started a super cycle in April. And you can look at the commodity index; it's already up 75%. Oil is surging up. Gold, silver, other commodities like copper. We believe we've entered a super cycle in commodity. I can explain a few of the backdrops and underlying pinnings for this. But at the same time, you're also seeing a flood of new investors, especially millennials and Generation Z, which up until 3 years ago were thought not to have any interest in stocks. In fact, there were many books that were written on this quote unquote demographic cliff, which stated that when the baby boomers need to liquidate their retirement savings in order to live from their portfolios that they've created, there will be no buyers, and we will see a huge, dramatic, depreciation in the price of stocks and real estate and whatnot. And it's the other way around. Generation Z and millennials are fascinated with stocks. Fintech has opened the world for them, and they literally can sit and talk about stocks all day long. Reddit being one proof of that, but they're on everywhere. They're on social media, on Discord, etc. And I just don't buy into the fact that they're being discounted as retail investors, because the power of going back and forth hours a day talking about an individual company, I think that might even have more in-depth research than what a hedge fund can do. Now, is it abused sometimes, like we saw in Reddit? For sure, it's abused, and there's there are people that take advantage of the power, the collective buying power of groups or chats or whatnot. But if you go back and think about the term idea meritocracy that comes from Ray Dalio and how he runs his hedge fund, where basically he's not the commander in chief. He doesn't give the final word on anything. In fact, what he does is he groups 30 or 40 people that have some expertise in a given subject, and they just go at it. They just exchange ideas for hours, and then they vote. And he doesn't have any power over other people. They can vote against him. They can say his notions are not true, and it creates this self mechanism of fact checking, a real fact checking, because the soundest and most logical idea surfaces because it's been resonated by the majority of the experts in the room. So I think that's what's really happening online, on YouTube and on other platforms. You get to speak. There are surveys going on, comments, chat rooms, etc. I think people are discounting the amazing power of that. A lot of the hedge funds, they pay to fly drones over parking lots of Walmart because they want to know if Walmarts are packed or empty. They want to know ahead of time, ahead of earnings. But man, when you have thousands of people on your communities and they take pictures of, let's say, a brand inside of Walmart and how it's selling out of the shelves, across the country, and how this company has now the best shelf space, or this one is getting squeezed out, you're getting a lot of insight. Something that a hedge fund manager with a team of 20 analysts, they cannot do, what thousands of people can do collectively. So huge shift. And I just don't think that P ratios as a whole are going to go down by a whole lot. I think we are living in a world of P ratios of 30 and over as a norm, as long as interest rates are this low. And also keep this in mind. Within all these QEs that were created in the past 10 years, QE programs, a lot of this synthetic currency creation because it went to the higher echelons of society, like the hedge funds and the people that manage billions of dollars. It went mostly to bonds and not to stocks. So you have all this synthetic money in bonds. We've actually seen a net outflow in stocks for the past 10 years, especially from 2018 onwards. So the bull market to me is not over in stocks. In fact, I think it has at least 5 or 6, maybe even 7 and 8 years to go. I think it's due for a breather for sure. Because I look at my own brokerage account and it's not normal what I'm seeing like every single day. Somebody's out there just bidding all of my equities higher, and that has an end to it. Like I said, at some point people will say, well, the relative value here is not as good as it used to be. Maybe I should take my money and put it in here or there, etc. And that's how either a correction or a pullback or a breather happens. But overall, I just think there's about $3 to $5 trillion that are on the sidelines and are going to come into the market in the next few years, especially the stocks, because that money is owned by millennials and by Generation Z, which are not only inheriting wealth from the baby boomers directly, but also they're inheriting careers from the baby boomers and generation. And the generation that came after the boomers. So, think about it this way. Today, 33% of the workforce is millennials. By 2030, it will be 75%. 75% of the workforce. 75. Yeah, that's a lot. So think about that. We're in a boom in the United States, not just in stocks, but in real estate. And it's just hard for people to get that mentality around them because they think about one, valuations, and two, they think about the national debt and the deficit, and they're like, this is impossible that these two worlds will coincide of huge unsustainable deficits and a booming economy. I think that's this duality will continue to coexist. The problem that it creates is this wealth and income gaps that are now part of mainstream. They're part of society and need to be solved either by government, hopefully not, but if the free markets can't figure out a way to do that, if CEOs can't figure out a way to incorporate more people in the workforce, to retrain tens of millions of people whose only skill is outdated, if this cannot be solved by free market forces, the government will intervene, and that will just be a huge redistribution of wealth, which is not the best outcome.
Yeah, fascinating. So people have been still emailing me, contacting me, asking me, what's the next GameStop? What's the next AMC or whatever, BlackBerry? Okay, so we've been seeing Reddit users pumping up stocks hundreds of percentage points within a matter of days. Does it make sense to ask what's the next GameStop, or maybe you know what the next GameStop is? What can you tell me about that?
I do not know. No, I've never been on Reddit, never been on Wall Street Bets, and I can't make it a habit of adding that to my daily routine.
Yeah.
Because I don't think it's sustainable. Now, having said that, I do believe a lot, David, in the power of these communities and chat rooms, etc. So I'm definitely part of many mastermind groups and many of these platforms that offer content. I absorb a lot of that because I like to see what people say about companies, either that I don't believe in or that I think are overvalued. What's the counter arguments? I love just to be part of the discussion so I can make my own decisions. So for sure, that angle of it I love, but to speculate on which stock could be their next target, I don't do that. I like that it inadvertently helped a few of my holdings last week, but yeah, but other than that, it's not part of my strategy. I
Sure.
would say, but with silver, I can comment a few things if you want to
Sure,
on
yeah, there was a huge squeeze in silver. The Reddit people turned their attention from companies that really are not that profitable to silver, of all things. And I'm
yeah.
sure it helped your silver stocks. And I believe you have
Okay.
a report on that, which I'll put in the description below this video if you want to tell us about that.
Sure. Wealthresearchgroup.com/squeeze is like an A to Z of what happened with GameStop and AMC and then silver. It's a full comprehensive report. It has some nice nuggets in there and insights, which you can go and download for free. Now, on silver, I would say this: a short squeeze in this day and age in a commodity is nearly impossible to perform. There's a few reasons why, and despite all that, I think that silver is going much higher, notwithstanding the short squeeze. So that's one thing I wanted to tell you. Now, when you look at a short squeeze in silver and you go and try and buy all the available physical supply, it creates a premium on the physical side of things, but it doesn't change ETFs that much or the paper spot price that much. In the 70s, and this is where this comes from, the baby boomer generation experienced a full-on squeeze in silver. Two oil billionaire brothers, the Hunt brothers, in 1979 went and loaned $3 billion back then at very cheap rates, and they bought about a third of global supply of silver and warehoused it. So it got to a point where silver just shot up so much, the government intervened. It banned long contracts, only allowed short contracts, and then they forced the Hunt brothers to unwind the position. So that created Silver Thursday, which was a huge sell-off. And I think in the past 10 years, people have gone back to that idea of suppression with the price of silver because of JP Morgan's spoofing trading, which basically is where you would put either a sell order or a buy order, a big sell order or a big buy order to spook investors into thinking there's a big seller out there, but you don't really intend to make that sell. You're not going to sell. It's just a trade that sits there either in level 2 or level 3. People can see it and then be scared of buying, or on the flip side, be scared of selling, but they never materialize. And JP Morgan got fined $960 million for doing that just a year and a half ago. And I think the CFTC has a bunch of rules that makes squeezing virtually impossible. I won't go into the intricacies of it, but I don't think it's possible. You saw a big dump in the price of silver once they realized it can't be squeezed. And the other thing is the short position on silver is not that big. It's very concentrated. So there's only a few actors that are shorting silver in a big way. But as a general rule of thumb, they're not naked shorting or anything that was happening in GameStop. And the other notion that, hey, silver's derivatives and ETFs and futures are much, much more than the physical supply. Well, that's true of all commodities. All commodities are, they have derivatives that are far in excess of the actual physical supply of them. The same goes for your ATM. So if you want to do a squeeze on savings, everyone rush to the ATMs, and there's not enough paper out there to match bank savings. So it's not something that just is happening with silver. And it's not necessarily a bad thing. Derivatives and futures have many uses and needs in the marketplace. If they're abused, like JP Morgan abused them, that's one thing. But their overall design is to help stabilize the price of commodities, supply and demand, etc. Actually, to make it more seamless, because obviously with any industrialized commodity, especially with silver, which has like 5,000 industrial uses, your ultimate goal is to make sure that the price is either stable or stable and declining, so you make everything cheaper for everyone to own. With that said, I think that silver prices are going much higher, not only because we started a commodity super cycle, but because there's a big new demand for them from solar panels. There's only going to increase. The annual production is already in deficit even before the solar panel boom. And so I think that that's coming into play. After 10 years of underinvestment in exploration and development and putting new mines into production, I think that is going to take 2-3 years to correct itself. So you have that. I think the dollar has entered a bear market starting in April of 2020. So when it peaked, when everyone was selling stocks and bonds and were asking, give me those dollars. I want to settle. And obviously when you settle anything, any sale, it's in dollars. So there was a huge demand for dollars. I think that was the peak for it. And we've entered a bear market in dollars that will last 6 or 7 or 8 years. Fintech and what Elon Musk just did with basically just challenging the US dollar, saying, hey, I'm going to invest in Bitcoin and I might even invest in gold, giving legitimacy to thousands of other companies to do the same thing and to millions of retail investors. There's a big pressure on the dollar. Obviously, we're seeing that politicians think that creating dollars has no negative implications. They're just saying, okay, as long as interest rates are this low, let's borrow and spend. It's going to help the economy grow. That's a myth, because they never account for that later. They never say, oh, you remember those days when we printed too much? Well, we need to raise tax. They never do that, and so I think these are big themes that help these things. And then the mother of all problems is ESG. You're just trying to put all these constraints on oil producers, nat gas producers, mining companies, and by making the world cleaner, they will make commodity prices go higher, because if a company has to do all sorts of things in order to keep the environment clean that cost a lot of money, that would raise the price of production, and that will raise the final price of a commodity. So I think that's coming. And of course, and all these redistribution of wealth programs, they call them stimulus checks, then they'll call them extended unemployment, then they'll call them universal basic income, or whatever they'll want to call them. But they're basically giving out money to the people that have been left behind. And the people that have been left behind are not going to put those funds in the stock market or in investments. They're going to spend. And that's going to create higher inflation. How much higher? I know people are always saying like hyperinflation, etc. Inflation is going to go from 1.5 where it is today to 2.5. And that's enough. That's a 60% move for inflation. And if it goes even higher than that, like 3%, well, I remind everyone that there is no living CEO that has ever governed a company under those conditions, because all the existing CEOs of companies, even the biggest companies, have only managed companies in a low interest rate, low inflation environment. We have not seen how this world behaves with 3% inflation in the United States in many, many, many years. So I think that's really something to think about.